Now, what do these inflation and growth conditions mean for monetary policy? Let me provide our assessment. We have made significant progress in bringing down inflation to below 5% in October 2023, despite occasional blips due to intermittent supply shocks. The summer of 2022 is behind us. Our policy of prioritizing inflation over growth, hiking the interest rates, that is policy rate, by 250 basis points in a calibrated manner, and draining out excess liquidity have worked well, alongside supply-side measures taken by the government to bring about this disinflation. The fact that core inflation has also trended lower and household inflation expectations have become better anchored gives us the confidence and conviction that monetary policy is doing its job. On the other hand, growth remains resilient and robust, surprising everyone on the upside. Notwithstanding this progress, the target of 4% CPI is yet to be reached, and we have to stay the course. Headline inflation continues to be volatile due to multiple supply-side shocks, which have become more frequent and intense. The trajectory of food inflation needs to be closely monitored. Intermittent vegetable price shocks could once again push up the headline inflation in November and, as I said, possibly December. While monetary policy would look through such one-off shocks, monetary policy has to stay alert to the risk of such shocks becoming generalized and derailing the ongoing disinflation process. In the midst of these uncertainties, monetary policy has to remain actively disinflationary to ensure a durable alignment of headline inflation to the target rate of 4% while supporting growth. I would now like to focus on the liquidity and financial market conditions. Like most other central banks, the Reserve Bank had injected additional liquidity into the system to counter the COVID-related onslaught on our economy. Consequently, the size of the Reserve Bank's balance sheet had expanded significantly. Persistence of such expanded balance sheet far too long could have created macroeconomic and financial instability. It is worth noting that the Reserve Bank has successfully reduced its balance sheet size well in time. Illustratively, the size of Reserve Bank's balance sheet swelled to 28.6% of GDP in 2020-21. With modulation in liquidity in the post-COVID period, the balance sheet size moderated to 23.3% of GDP in 2022-23 and further to 21.6% in the current financial year up to December 1. We consider this as a significant achievement. System liquidity, as measured by net position under the Liquidity Adjustment Facility, that is LAF, turned into deficit mode for the first time in September this year, after a gap of nearly 4.5 years since May 2019. Deficit liquidity conditions persisted during October and November, prompting large recourse to marginal standing facility, that is MSF, by the banks. In parallel, utilization of standing deposit facility, that is SDF, has also been high. The overall tightening of liquidity conditions is attributed mainly to higher currency leakage during the festive season, government cash balances, and Reserve Bank's market operations. Driven by these autonomous factors, system liquidity tightened significantly compared to what was envisaged in the October policy statement. Consequently, the need to undertake auction of OMO sales has not arisen so far. The evolution of liquidity conditions has been in alignment with the monetary policy stance. More recently, however, as government spending has picked up and system liquidity has got more evenly balanced among market participants, pressures have eased and the net LAF position has evened out broadly. Going forward, government spending is likely to further ease liquidity conditions. On our part, the Reserve Bank will remain nimble in liquidity management.